Hi, and welcome to the Wealth Channel. I'm here today with Don Graves and Shelley Giordano, and we're talking about reverse mortgages. Shelley, let me start with you.
Sure.
What is the HECM program, and what are the challenges that it's faced?
Well, the HECM is the Home Equity Conversion Mortgage, which is an FHA insured mortgage. Believe it or not, it was initiated by Congress, the 1987 Congress, and signed into law by Ronald Reagan in 1988. And the intent of the program was to provide a safe vehicle for retirees to get to their housing wealth throughout the course of their retirement. Unfortunately, over the last few years, the product has been marketed and used inappropriately by people sometimes who maybe should not have been using reverse mortgages, people whose financial situations were so poor that they couldn't meet the obligations of home ownership, which would be taxes, insurance, and maintaining your home. So HUD, FHA, has addressed that and has instituted some rules and regulations that make the program available only to those people for whom it will be suitable, which of course is what we all want.
Okay. In 2013, there were some specific rule changes to address some of the concerns. Could you explain them?
Sure. In 2013, some of the bigger changes were there was a reduction in the amount of money that was going to be made available to the client. What we call the principal limit factor tables changed. So before, if you were able to get $200,000, that was going to be reduced somewhere between 16 and 18%. Okay. So they throttled back the program in order to preserve more equity in what was then a market that we didn't know if the housing market would recover or return. Secondly, they throttled down the amount of money you could take out up front, which means there was no longer going to be a cash out lump sum option for reverse mortgages. And again, this was to protect the senior, to say, we're not going to make all of this available to you. The people who were in technical default, when HUD did a survey, the ones who were most culpable were the ones who had taken out a lump sum up front. So they did away with that. A third feature was the line of credit option, to set up a standby line of credit. Again, you were not going to be able to access 100% of that line of credit in the first year. So if you're eligible for, say, $200,000, you can only access up to 60% of that the first year, and the rest any year or any time after that. Again, all of this was done to preserve the equity, to kind of make sure we had a borrower that fit the long-term goals of the program and the history of the program.
And they could afford to have one of these loans. Really,
yes, sir.
And stay in their homes.
Yes.
Okay. More recently, we've had some additional changes around qualification. Can you explain those?
Sure, and I'll ask Shelley to chime in as well. As a part of the Stabilization Act in 2013, there was a part of that called financial assessment, which was looking at a potential borrower and evaluating their income and their credit risk factors to say, are they able to maintain their housing obligations, property taxes, insurance, homeowner association fees, and to say, if they were not, what were we going to do about that? Originally, it was designed to be implemented in January 2014, but HUD realized that we need more study, more input on that, so that got pushed back. Just recently, I think in mid-November, HUD says we're going to implement that March 2nd of 2015. This is to ensure the sustainability of the program. So financial assessment will begin looking at a client's ability to maintain their housing. Again, property taxes, insurance, homeowner associations, as well as their credit history.
So prior to these rules, there were no income or asset requirements of any type. You just looked at the value of the home, and that's how you qualified for the loan, correct?
That's right. You had to be of a certain age. And so now we're going to look at, does this borrower meet a residual income requirement? So every county in the United States says that after you've subtracted your mandatory housing obligations, how much money is left over? $843, whatever the county is. So the first thing is, does the client meet the residual income qualification? The second they'll look at is, what's their credit, what's their attitude towards revolving credit? And I don't know if I'm saying that right, Shelley,
no, that's right, yeah.
But their attitude towards revolving credit, what has that been? Primarily mortgage debt, loan servicing, property taxes, homeowners insurance are the big ones. But at the end of that process, one of three things can happen. We'll say to the borrower, you're approved, you can proceed with the reverse mortgage. Number two, you're declined. You cannot obtain a reverse mortgage. Or number three, you're approved with conditions. And those conditions can be, we're going to set aside taxes and insurance not to be accessible to you, but we're just going to reduce the amount of your reverse mortgage benefit, setting aside a tax and insurance escrow type of account, but it's not accessible. So in essence, in case you go into default, the lender or the servicer has a pool of funds over here to be able to use on your behalf, but the borrower himself would not be able to access those funds. So that starts the 2nd of March.
And all those changes sound related, right? They're all about making sure we're making loans to the right people who can afford
to the right
have them.
people. And you know, I think for the financial planners, your audience here, this is probably less of a concern because they're working with people who have assets and helping them protect their assets. And you know, very rarely would they be coming across clients who would not qualify for a reverse mortgage because they're people who've been responsible with their financial obligations throughout their lives. So this will be a non-event for planners.
So for financial advisors working with clients, the real news are all the interesting strategic ways we've sort of figured out how to use reverse mortgages.
Your industry is teaching our industry. It's not something we know, but there's been a lot of academic work, very interesting and exciting work out there, demonstrating that the conservative use of housing wealth, judicious, prudent use of housing wealth, you know, over time and during the distribution phase conveys enormous protective effect on the nest egg, and that's the message. Different, you know, the different case studies and different ways of going about it, but the message is, you have clients who have assets that need to be conserved through what could be a very long retirement, and don't ignore that other asset, that housing asset, because the studies are showing that when you coordinate or weave all of those together, you can make an enormous impact on cash flow survival probabilities.
Okay, so reverse mortgages are alive and well.
Alive and well, alive and kicking, yes.
All right, and more and more a part of retirement income planning.
Absolutely.
Absolutely.
Great, thank you very much.
Thank you.
Thank
David.
you.
And thank you for watching the Wealth Channel.